Okay, this problem is very similar to one we just did. This is question 2 of homework 3C. We have treasury bonds with their supply curve and demand curve. We have corporate bonds with their supply curve and demand curve. They're identical because, again, we start off assuming that these markets, that these pieces of paper, these debt instruments, are identical in all characteristics, whether it be liquidity, default risk premium, number of periods, the face value. So if they're identical, and the only difference is who's printing the paper and selling them, then they're going to end up with the same price and quantity. And I've already copied and pasted the supply and demand curves into Desmos right here. So there's demand and the supply curve. And the price of these bonds is $818.80. The quantity is 724. The face value of these are $1,000. There is no coupon because it's a discount bond. Zero coupon bonds are discount bonds. And then the number of periods is 1. And then we got to calculate the rate, which is equal rate, the number of periods, the payment, which is 0, negative price, because we were paying the price of $818.80 for the right to get the $1,000 in one period. And the interest rate is 22.130%. Whether it's a corporate bond or whether it's a treasury bond, the price, whether it's treasury or a corporate bond, is $818.80. The quantity is 724 billion sold. The quantity demanded are the same. And then because quantity supplied equals quantity demanded, there is no excess demand slash supply. So we'll go ahead and hit enter. And I'm not going to, if you want to know how to graph or label these graphs, just watch the previous video. You'll put price here, supply here, demand here, quantity here. You put a dot here for the equilibrium. You'll dash it down to here, dash it over to here, and then you'd write corporate on top of this. And you'd write treasury on top of that. We've already done that in the previous video, so I'm just going to move on. Okay, now, because treasury securities are backed by the U.S. government, they're essentially good as cash. This means there are always investors willing to buy them when other investors wish to sell them. And it's very liquid. Yeah, lots of people buying and selling them. They're probably the biggest market on the planet. Corporate bonds are liquid too, but they're not as liquid as treasury. The market's just not as big. And what I mean by the market not being as big, there's not as many people willing to, that are in these markets buying corporate bonds as there are people wanting to sell treasuries. So when there's more people want to buy something, that market's bigger. That makes them more liquid. So if we hold default risk, if these are basically have the same probability of default and everything else is identical, it's just that the corporates are less liquid, less easy to turn into cash, less easy to sell for cash than treasuries. What's going to happen is the demand for treasuries will go up. People will want that liquidity. They'll be willing to pay a higher price, and the amount of people that enter this market is going to be roughly equal to the amount of people that leave this market. So if people realize that all of a sudden, hey, these treasuries are much easier to sell, then just that one factor alone will push the price up a little bit. It won't push it up forever because at some point the price is too high. And people won't leave this market because the price is coming down a little bit, right? So let's go ahead and put in the demand curve for treasuries into Desmos. And we'll do the treasury first. Whoop, I forgot the P. Okay, so let's get the treasury price and quantity. So for the treasury, because of liquidity being much more liquid than corporates, the price gets bid up to $830.40. Whoop. The quantity increases to 782. The face value is 1,000. Coupon is 0. Number of periods is 1. And the rate equals got to put a negative sign in front of that. And then 1,000. Oop. So the yield to maturity went down, the interest rate went down because the price got bid up a little bit, right? So for the treasury, the yield is 20.424%. The price got bid up because people are willing to pay a little extra for that liquidity, just in case there's an emergency and they have to liquidate their assets. And it's much better to liquidate an asset that's got a lot of buyers than an asset that's got fewer buyers. And the quantity of bonds is 782. Okay, and we'll go ahead and hit enter to see if we got them right. Yep. Okay, now let's do it. Let's do that for the corporate bonds with less liquidity than treasuries. So I'm going to replace the red one with the red one. The one that was red before was the treasury demand after people realize, hey, these are more liquid. This is the demand curve for corporates when people realize they're less liquid. And then I'm going to go ahead and copy this and paste it down here, and I'll call this corp with less liquidity, right? Okay, the price got bid down to 807, $807.20. There's only 666 billion of them being sold. The face value is 1,000. The coupon is 0. The number of periods is 1 because everything else is held constant, right? And the yield increases to 23.885%. So the yield is that. The price is 807.2. And the quantity is 666. Okay, so if corporate bonds are just as likely to default as treasury bonds, and everything else is identical with the exception of liquidity, the illiquidity risk premium is the difference in the two interest rates or two yields. So in this case, 3.461%. Again, I'm not going to graph this. This is the, I'm not going to label the graphs. This is the treasury market. So you want to write treasury here, corporate here, price, quantity, big black dot here, big red dot here, big red dot here, big black dot here, draw a dash line straight down, and then dash line straight across. Okay, and then label this supply with more liquidity, and label this supply with less liquidity. And you can just look at the previous video, question 1 in homework 3C, to see how I graph that. Okay, now we got a similar problem to what we did before. We have we're considering owning two $1,000 bonds that mature next year. One is a corporate bond, the other is a treasury, and both have a coupon rate of 15%. Why is the price of treasuries higher than the corporate bond with the same attributes? We're going to assume the price of treasuries is 1,062, and the price of the corporate bond with the same attributes and zero default risk is 1,036. Okay, so I went and edited the question. Let's read this again. Assume the price of treasuries is $1,062 and the price of a corporate bond with the same attributes and zero default risk, so both have zero default risk, is by assumption 1,036. The only difference between the two bonds is that the treasuries are easier to sell than our corporate bonds. Okay? So we're assuming here the only difference is the ease at which we can sell them and liquidate them and turn them into cash. Okay, so let's go down here and do the before and after. They're both $1,000 bonds. I'll just type an equal sign there. They both got a coupon rate of 15%. So the coupon payment would be $150. They're both maturing in a year. The price, whoops, this is the treasury. And this is the corporate. Okay. The price of the treasury is 1,062 and the price of the corporate is 1,036. People are willing to pay a little bit more for the treasury because it's going to be easier to sell just in case you have to liquidate it for cash. Okay. Then I'll pull this down. Okay, now we need the rate. So equal rate. The number of periods. 15% of 1,000 is $150. The price is 1,062 and the future value is 1,000. So I'll go ahead and pull this over here. Whoops. So the number of periods is 1. 15% of 1,000 is $150. The price is 1,036 for the corporate bond with less liquidity, and the face value is 1,000. And the difference between these two yields is called the illiquidity risk premium, and it's 2.72%. The yield on the treasury with more liquidity is 8.29. And the corporate bond yield is 11.00%. We'll hit enter to make sure we got it right. Okay, we did. Okay, good. Now, according to the figure below, the illiquidity risk premium in a given year roughly equals the vertical distance between the red graph and what? The red graph is the corporate AAA bond rating, and the dark blue graph is the government long-term bond yield. Okay, and I'm going to argue that the difference between the red graph at a given point in time and the dark green graph is the liquidity premium, or the illiquidity premium. Okay. The reason why I say that is because there are people looking for corporate bonds, and there are people looking for bonds in general. And the people that are willing to, there's a lot more players in the government bond market. So you have these corporate bonds, and then you have these treasury bonds. And the treasury bond market is just so much bigger than the corporate bond market. So I believe the difference in these two the red graph and the dark green graph at a given time period is the illiquidity risk premium. Okay. So I had to go and edit the question. This was copy and paste error. So the illiquidity risk premium reached a historic high in what year? So we're looking at the difference between red and green. Well, the down here is probably, this is 0 here. So I would say 1945. This looks like 45 right here. 1945 here. Red and green. And then this distance from dark green down here, you can't really see it, but down here dark green, up here to red is probably the biggest difference between red and green. So I would say 1970. And that's it. We should get the answers correct. And we do. So that's illiquidity risk premium.